Shall I start, or do you want to? Depends who's got the better ideas. I don't know. Well, it's tricky, isn't it? Because we can't give advice, so it's different for every person, isn't it? For me personally, though, I think I would definitely diversify to begin with. Play it safe. I think it's all about developing your own personal strategy that works. So I think that, and it depends on people's age, all the rest of it, you know. So I mean, when I did start investing, that's probably the best way of talking about it. I did what a lot of people do, and I just went for story stocks, mining shares, anything speculative, and it just didn't work. So I think I followed newspaper tips, magazine tips, didn't really do any particular in-depth research, and I think that's what most people do when they start, and usually have a period of several years where they have unsatisfactory results. And I think it's only then when you start to really develop your own personal strategy, and ultimately it's whatever works, so depending on where people are in life and what they want to achieve and so on. Yeah, I mean, there comes a tipping point, doesn't there, where you don't want, say if you've only got £5,000, I wouldn't say it makes any sense to have 10 positions, really, does it? No. In that case, it'd be better off, I would say, I would personally concentrate into just 2 or 3 positions, but I'd really do my research thoroughly on them and make sure they're proper, decent companies with limited downside but good upside. Yeah.
Well, when I started, I did the opposite of you, actually. I bought the ETF for the entire index. So I just bought a stock market ETF, and I can't give advice, but it does seem like a reasonable thing to do when I didn't have a huge amount of money, and therefore to take a lot of company-specific risk for someone who's new to investing seemed very risky. So I was happy just to buy the market, and that was dipping my toe in the water. Equivalently, I could have bought some funds, mutual funds, a pretty reasonable purchase for people who are starting out. You could follow the fund manager and see what he's doing and what companies he owns before you buy specific companies. So you don't have to go in head first into risk. You know, you can gradually take on more and more company-specific risk as you learn more about companies.
I think it depends on what you're doing with the rest of your time. If you're a full-time investor, as I am, then actually monitoring hundreds of companies is perfectly doable. If it's your passion, if you're interested in it, that's the key thing, isn't it? Whereas I think for people who are working full-time on something else, don't really have much time to check the market, then certainly stop losses are probably a good idea. And I mean, as Graham says, maybe just putting the money in a fund. I think people should only really manage their own, well, I shouldn't say people should, because people can do what they want, but I think for me it was all about that I had a passion for the markets and I wanted to research companies and I enjoy the process. So, and also it's a competition. I want to outperform or develop a system or technique that means I can outperform the market. So.
Yeah, I mean, if somebody has enough money to retire and they're happy to earn the index, then they can do that. But for people who want to challenge themselves and want to try to beat the market, certainly if they had $500,000 and if they were investing full-time, they could own quite a few different stocks, or they could it's really up to them and their investing style and how much time they have and how many stocks they can research. So it's sort of an impossible question to answer in general, but for me personally, when I managed a fund for an institution, I was happy to have 20 active positions, which I felt was more than enough to be diversified, but also to have exposure to the companies I really liked. So for me 20 is plenty diversified.
Well, I've got a pretty spectacular story of investing failure after the bull market of 2003 to 2008. I'd made quite a few million, and I lost the lot in 2007 and 2008. And for a very specific reason, I'd geared up using spread bets, but I'd geared up on illiquid stocks, in particular one very, very oversized position, which was more than half the portfolio. And I knew that the one risk I wouldn't be able to cope with was a general market crash, and I thought, well, they hardly ever happen. There hasn't really been one since 1987. There's nothing to worry about. I'll see it coming, da-da-da-da-da. As you can probably gather, hubris had definitely set in by then after 5 or 6 years of making money hand over fist, and I ran headlong into the financial crisis in 2007-8 with a geared up position in one stock in particular, Indigo Vision, that I couldn't get out of. At one point I owned about 8% of the company. And it was a disaster. Basically everything collapsed and I lost all my money plus another 2 million. So it took 10 years to fix those problems. So I've certainly learned my lessons the hard way, and the key lesson to learn is gearing on its own it can be dangerous. Illiquidity on its own can be bad, but if you combine the two, in a market downturn it's catastrophic. So people, in my view, if there's one lesson to learn from me ever, it's don't spread bet on illiquid microcaps, because in a downturn you'll get carried out on a stretcher, as I was.
Great.
Sure, well, I've never used gearing like Paul has, so my mistakes are less dramatic, but I have made plenty of mistakes and I've learned from them, I believe. The main mistake has been just buying deep value companies that were fundamentally flawed, and I only suffered one absolute loss, but I suffered a lot of sort of stagnant stocks which weren't going anywhere, and so that's really changed my style over the last few years.
Well, for me it was really a desire to cover the entire market in small caps. So this was a challenge I set myself in 2012, because I thought I've got to do something differently. I still was on the floor after the wipeout I suffered in 2007-8. So I thought, well, let's set myself a challenge of covering all UK small caps within sectors that I like, which is most sectors, excluding natural resources companies and a few others. And that's how the Small Cap Value Report began, initially as my own personal blog, and then it was brought into Stockopedia. So, hell, I've forgotten the question, sorry. Finding stock ideas, that was it. So for me personally now, it's direct from the source. So I look at trading updates and results statements every day. The reason I do that is because other coverage from journalists or other commentators or friends of mine and so on will come later, because they've looked at the RNS as their initial feed as well. I'd rather go to the direct source. Now I've got this knowledge of 500 or 600 small caps, I can quickly interpret RNSs, and very often the early bird catches the worm, I think, in game-changing type situations where a company suddenly puts out an unexpectedly good trading update. If you can move fast, and this is where private investors have a massive advantage over institutions. Institutions, a lot of them will not be looking at small caps at all, and the ones that do can't just go into the market and buy a lump of stock because the market's too illiquid. So this is our big advantage, I think, finding the best ideas and finding them first.
Yeah, and the way I find ideas would be similar to Paul in the sense that I'm obviously reading the news every day, so that throws up lots of new stocks. I also take suggestions from people, from readers, about stocks that they're interested in. I also have phone conversations with other investors who tell me what they're investing in, and that's a great source of ideas too. I mean, just keeping your eyes open. I use Stockopedia screens as well for ideas. I like to rank by quality and value mostly. So I tend to focus on the sectors I like the most and rank them according to some quality and value metrics and see what comes up.
Okay, cool. Can I just add one other point as well? Often I find if I like a particular stock a lot and it's one of my largest positions, then I click on the box on the stock report that says what Stockopedia screens that stock has passed. And if you click on that, it will bring you through to a stock screen that will include that particular stock that you like, and sometimes I'll find other stocks in there which have similar characteristics that I wasn't aware of. I mean, even though we cover most of the market, it's surprising there's still sometimes...
Do you ever create your own screens?
Yes, I do. Yeah, I do. I used to screen on very boring things like looking for low PE, low debt companies, high dividend yields, but I found that strategy was just throwing up too many problematic companies, if you like. So now I've got some more screens where I look particularly for earnings upgrades and for earnings beats, and I think those can often flag up, and relative strength, funnily enough, is a new sort of string to my investing bow. In a bull market, I think growth companies that are beating market expectations can be very good.
Yeah.
Yeah, well, I've already sort of taken a Brexit hit because I was invested in some importers who've suffered from the devaluation of sterling. I'm not a currency analyst by trade, but my instinct is that we're at peak uncertainty and that sterling probably can't go much lower than this, on the basis that any sort of resolution would bring money back to sterling. But in terms of my investing plans, it's not really something I'm thinking about now, because like I said, the importers that I bought have already taken that hit, and going forward I'm not really going to try and predict what happens to sterling after this.
Yeah, I mean, with regards to Brexit, I feel that in terms of the movement of physical goods, I'm supremely confident that there won't be any serious problems, because Britain's a large net importer of goods, so there's absolutely no question of the EU wanting to impede that in any way. It would be a stupid, ridiculous thing for them to do. Both sides want free trade, so one way or another, I have no idea what the terms will be. I think free trade will continue. So I actually don't think much will change because of Brexit at all. Where I am a bit worried is on services. That could be a lot more complex and potentially detrimental to the UK if, active steps are made to try and impede British financial companies doing business in Europe. That again doesn't particularly bother me, because I don't buy any shares in financial sector companies. So I think one way or another it'll all get sorted out. Graham's mentioned the currency impact, which is important. I tend to agree with you. Again, I have no idea what sterling will do. I've focused my portfolio mainly on companies where there might even be a pleasant upside surprise from weaker sterling. So companies like which are mainly exporters and so on. Bear market hits us tomorrow. Well, bear markets don't generally
just turn around.
Happen in a day, do they? I mean, even if you look back at 2007, 2008, it was a very gradual process with powerful rallies, which is typical of bear markets, isn't it? And then you get periodic shocks, because I remember in 2008, Bear Stearns went bust in March, which was a huge shock to the system. Some sort of recovery over the summer. Then the real killer was Lehman Brothers, wasn't it? And AIG in the autumn of 2008. So these things come in waves, I think. So we saw a similar thing with the various euro crises in, I don't know, it was over several years, wasn't it? 2009, 2010, 2011 maybe. So bear markets, well, I suppose you don't go against the general trend, do you? If sentiment is bad and people just want to sell things on the rallies and so on, then the sensible thing is just to watch what's going on and act accordingly, isn't it, really?
Well, I'm positioned quite conservatively. So I'm not fully invested in the markets, and if a recession or a bear market were to hit tomorrow, I would ideally try to buy more stocks, because I'm already quite underweight versus equities. So I would be hoping to increase my equity position over time during the bear market.
And just one small additional point as well that we mentioned earlier. Bear markets generally don't happen in isolation. They happen because corporate earnings are sharply falling, because there's some sort of economic negativity going on, whereas at the moment it's the opposite, really, outside of Britain anyway. You've got synchronized growth around the world. You've got big corporate tax cuts looming in America, which should be very good for American companies. So even though I think we probably all agree that stocks are expensive everywhere, well, in America and Britain anyway, which is where I look, I don't see what the short-term catalyst is for that to change anytime soon. But having said that, I do put short positions on to balance up my portfolio somewhat, to reduce my overall market exposure.
Well, I'm such a fundamentalist that I won't sell it unless I've figured out what the problem is. I mean, if the share price is collapsing and I don't know why it's collapsing, you know, then maybe I'm not a very good investor. But usually I know what the reason is, why, at least why other people think it's going down, because there's usually discussion, or there's people, you know, so you can usually figure out why other people are selling it, and then you make a judgment whether you think they're right or not. If I disagree with the reasons to sell, then I don't sell.
Pretty similar for me. I mean, I don't use my initial purchase price at all in my monitoring spreadsheets, because to me it's irrelevant, almost random what price I happen to pay for a stock. There's only one thing that's right or wrong, whether I should currently be holding that stock or not, based on what the prospects for the company are and based on the valuation. So I forget my purchase price as quickly as possible, and for that reason it's irrelevant to me what the share price is doing. Obviously, if the share price has dropped 20%, there's some reason for that. Usually a profit warning might knock a share price 30%, so I'll really carefully consider the profit warning. I'll ride out some downturns if I think the profit warning is something short-term and fixable. I would probably buy more in that situation. If there's some sort of structural problem with the company and I think the profit warning is possibly the tip of the iceberg, then I'd be out like a shot as quickly as I could. So every situation is unique. Well, I had a bit of a passion for microcars years ago, and I accumulated a series of tiny Fiats and a three-wheeled Bond Bug and various other ridiculous things, but they all had to go in 2008. So my next, I'm currently driving a leased car, but my next purchase is probably going to be a 1992 Series 3 Jaguar or Daimler 66, because they're quite good value. They're about 10 grand, and I think they're beautiful cars.
I am a gold bug, but the way I express that is by owning shares in a pawnbroker whose earnings are, you know, very much geared towards with the price of gold. I used to buy gold bullion by itself, and I used to buy gold sovereigns, which was fun, but it's not really an investment.
Okay. So. Awesome, brilliant. Thanks, guys.
Thanks.